Welcome, everyone. Thank you for joining us live here on our first Endeavour Exchange, where my business partner, Grant White, and myself, Brandt Butt, are going to be talking about a variety of topics today, all of those that may be playing an impact or having an impact on your money. So, again, thanks for tuning in and looking forward to kind of covering these topics with everyone tuning in today. So, with that, Grant, let's get right into it. I'm going to turn it over to you. We've had a lot of recent news around, positivity around vaccines. Two of them in particular. It's seeming like we're getting a lot closer to a world where there is a vaccine, and because of that, I think it's an important time to maybe be asking the question: what does a successful vaccine mean for the markets over the short term?
Yeah, well, just want to say, first of all, I love this format because I think this is going to be a lot of fun, one, and two, it's going to get a little bit more raw answers between us as we go through like the current topics of the day. And yeah, certainly the vaccine has been a hot topic we've been following a lot this week, and the recent developments that have come over the last week. And so, in my mind, like, I think that what we're looking at is volatility. We've seen that both on the upside and downside. So, in the short term, I think the prospect of a vaccine is going to create some short-term volatility. I'm also seeing FOMO out there a lot. I mean, I don't know about you, Brandt, but I think that there's a lot of people that are feeling the FOMO. They've either missed the ride and they're trying to catch up with what's gone on this year. I mean, there's been some huge wins to be had in the market, obviously, and I think that's super dangerous. I think there's a lot of people who are trying to chase the returns that we've seen out of, especially like the big tech out there, the big tech companies, which were climbing again today. But I think there's going to be a lot of FOMO. I think there's going to be volatility, and I think it depends on what your definition of a short term is as well. I mean, if we're looking at over the next 12 months, I do think it presents a rosier picture for 2021. Certainly, especially if the vaccine is successful. Pfizer's talking about having some distribution to healthcare professionals by the end of this year already.
Mm-hmm.
So I think that presents a rosy picture for 2021, which obviously could create some lift in the markets. But I also think that it could change some of the leadership that we've seen in the markets as well, where again tech has led the way. But is that going to be the case next year?
Yeah, I agree with you on the volatility because some of the news that we've had, it's fairly early. Like the news that we've had around both the Pfizer and the Moderna vaccines, which both now that we have more data around the Pfizer, in that it was actually 95% effective as they had even more COVID cases coming forward. Since we learned that it was effective in certain subgroups like the elderly, and that as well it did help in preventing a lot of those severe cases of COVID that we've been seeing. But at the same time, we have some information around these vaccines, and I think it's good news, and the markets like the news when we hear it. But at the same time, there's still a lot of logistical challenges as it relates to these two vaccines, and specifically the temperatures at which they need to remain at in order to essentially be able to be distributed effectively. So in Pfizer's case in particular, it's a very sensitive vaccines from the sound of it, and it needs to be kept at an extremely low temperature, which will obviously present some challenges. And actually, it's one thing to have a vaccine, and then there's the other side of it where you have to actually get it out to people. So
Yeah.
Depending on how the logistics of this go, I think volatility is possibly, well, we've been seeing it, but continued volatility is probably highly likely as we have new developments with the vaccine and get new information, because it is early. Most of us, we don't come from a pharma world or biologists, or we're not infectious disease doctors. So a lot of this is new information. It's changing information, and it's going to change investors' essentially perception and behavior in the markets.
Yeah, well, I think volatility is a given. I mean, and that doesn't necessarily mean a bad thing. But I was on a panel last week for ETF Canada, and one of the things that I said on the panel was, when they asked me about what does next year look like, and I'm like, I feel like we're one bad news story away from a 20% drop in
Yeah.
these markets, but evidently we're one or two good news stories away from a 5% gain on a single day, basically. And so volatility is certainly going to be out there, but that doesn't necessarily mean a bad thing. I just think that it's a dangerous spot for investors who are trying to catch up in this market,
Hmm.
who maybe missed the ride of a lifetime, and then they're trying to make up for it. So that's dangerous. But at the same time, I think it's going to create lots of opportunities, and certainly a viable vaccine presents a positive situation overall.
Yeah, and the other side of that I didn't mention is just who gets the vaccine. There's going to be obviously some challenges. We've heard talks. Makes a lot of sense to have healthcare workers being some of the first, but what about people like teachers,
Yeah.
daycare, elderly, like rolling this out and making sure that it still remains to be seen exactly how long we're going to be living in this world with social distancing and a lot of the new procedures and policies we have to follow when we go into buildings and retail stores and things like that. So volatility, looking a lot more optimistic, but at the same time, I don't think we're out of it just yet.
Yeah, no, I'd agree with you on that.
You touched on it briefly there, where you talked about some of the tech stocks and how well they've done. I know several weeks back, or a couple weeks back, when we first got the news around the vaccine, we had a little bit of a boost in some of the more beaten down companies and beaten down stocks, which had many talking about stock market reversal. So the question I have for you is are we due for a stock market reversal in your opinion?
That's the question, right? It's so I think that there's certain parts of the market that have yet to catch up. That's for sure. I think that I mentioned FOMO is a big risk on the other side of this. I think that there is money that's still going to be going into techs that is trying to catch up on the ride. But
Yeah.
I do think that there's parts of the market that, like on the cyclical side in particular, that have certainly lagged the market overall, because things have been driven by the big techs. You look at the S&P 500, and a huge portion of its growth has been led by like 5 companies, basically. You're looking at Apple, Amazon, you can throw in Microsoft, Alphabet in there, Facebook, and that's kind of led the way, and those have really gone on a tear. And the same thing with the work from home stocks. But I think there's 2 things at play on this. I think there's the positive news on vaccines. I think that's a positive play for a potential reversal, because a lot of things that have been driving these stocks have been work from home. So if that is no longer a big case, a big story going forward, then yeah, we could see reversal there. But I also see that the U.S. political situation, and it doesn't matter what side of the coin you're on as it relates to this. I think that more importantly is that there's going to be less. There's going to be more certainty around it, and that's because in any election there's uncertainty about how it's going to play out. Never mind this most recent U.S. election, but I think with more certainty going forward, now that Joe Biden has won the election, I think that's going to potentially cause a rotation out as well, and not just out of like tech stocks, but out of potentially like safer assets, like looking at gold or looking at really safe bonds. Like I think there's definitely been some fear out there this year as well. I mean, we forget that we were still going with the pandemic, and although the stock markets have risen, there was a lot of fear, and we see that from clients. I mean,
Yeah.
I was dealing with a client today who's still dealing with a lot of fear, and we're guiding them through that. And so I see that there's potential for that rotation coming out of safer assets and cash. There's definitely some cash sitting on the sidelines. I'm looking at companies today that are building up cash as well on their books. Like Shopify's built like $5 billion of cash, and a lot of other notable companies have built up cash. Now, not to say that they're going to put that in the stock market, but
Yeah.
I think the point is there's a lot of cash out there where that as we have more certainty going forward about U.S. politics is a big one for the world, and the vaccine and the pandemic in general, we naturally get a rotation. But I also think it's an interesting conversation, because I think that we're potentially looking at a potential spending boom that may come out of this as well. We were talking about the booming 20s a couple of days ago with some of my friends. We might have a repeat of that, as we're looking at pent-up demand. That's just built up. I mean, people obviously can't travel right now, or not do the travel they necessarily like to do. People might be holding back on certain consumer discretionary items, and so I think there's potential to see a big boom in spending as well, leading out of the pandemic, and that obviously would cause a rotation out of the tech leadership as well in the stock market.
Into some of those obviously beaten down names in the cruise lines, airlines, entertainment, theaters, sports and entertainment. So I had some interesting numbers that I pulled, and I was just looking at from the vaccine announcement, and I looked at the Russell 1000 Value Index to see since the November 9th announcement of Pfizer, what's happened since, and the Value Index, so some of those more beaten down traditional names, is actually now up 5.9%. For the growth index, as you mentioned, a lot of money moving out of those stay-at-home names as we had more positivity around that. There may be an end in sight. The growth index was actually down 1.1%. However,
Yeah, that's not surprising.
Not surprising at all. But then I wanted to take it back even further to kind of get a better picture and look at, since the pandemic began, where are these two indexes at? And if we actually look at the growth index, it's still up 28%. And if we look at the value index, those beaten down names, still down 4.5% approximately. So value still has a way to go. The work from, like you said, the work from home, the e-commerce, gaming, indoor entertainment, these trends have prospered during this time. So we'll see what that means. I don't think it's necessarily, for some of these companies, I think that trend was already on its way, and the pandemic really just accelerated this. So I don't necessarily believe that all of those businesses that the minute we hear that a vaccine is on its way and that it's going to be coming and we are near the end, I don't think all of the names that have benefited are necessarily going to fall or become out of favor by investors. A lot of these are good companies. The trend was already that direction before the pandemic, and you're seeing it with like the Disney Plus adding 73, they're up to 73 million subscribers now. Walmart moving more towards e-commerce, that's propelled them further down that road, where we knew they were already having to go that way, competing with Amazon, but just recently in the past quarter, they've increased their e-commerce growth 73% year over year. So I almost don't think that it's a question of value versus growth. Number one, I don't think we actually believe in that you can pit the two against one another. Even in growth investing, you're trying to buy a business for less than it's worth, which you're buying it based upon what you think the value is. So, but like I said, I don't believe this is a story of value or growth, and that we necessarily need to separate it. I think it's actually a lot easier just to look at the individual companies and see exactly what's leading to their success. We talk about the digital trends. We talk about the trends towards e-commerce, customer experience, essential items, home rentals. So it's no wonder, when people have nowhere to go, nothing to spend on, that they're doing those home renovations, and we're seeing an uptick in companies like Home Depot. From the e-commerce side, Shopify is now the biggest company in Canada, or the largest, has taken over the largest market cap, taken over RBC recently. And it should be of no surprise given this environment, because people were having to move more towards digital and online. That was already known. This just really forced companies who maybe have been resisting that trend to either get on board or suffer the consequences, essentially. So
yeah, no doubt, like, good businesses are going to be good businesses through this, and yeah, by no stretch do I think like Apple is going away. Apple is one of the best companies in the world, and yeah, have they benefited from the pandemic? Probably, yeah, absolutely. Amazon, likewise. I think Amazon's a good company. Alibaba, I think, is a great company. So there's companies that have definitely benefited from this, and by no stretch would I suggest that they're not going to be good companies or good investments necessarily going forward. But on the flip side of it, look at some Canadian banks, for example, that have completely lagged and are great businesses as well. And there's a lot of reasons why they have lagged. But just recently we've seen them start to pick up steam again and start to catch up. And I think that's just part of the rotation. But no doubt, like, e-commerce is here to stay. I think The Economist actually did a survey, and 60% of people are planning on either continuing on with their new e-commerce habits, if you will, going forward, or even increasing them. So it's here to stay. It was a good trend before, and it's a big trend going forward. Obviously, that was just accelerated, as you put it. But that kind of brings up an interesting point, though. With COVID spending leaking outside of Canada, actually, there's something that we've seen more recently. So,
yeah.
What can Canadians do about that?
Yeah, actually, as you alluded to, there's a recent report issued by a CIBC economist that took a look at, suggested that consumer spending on imports is actually causing leakage with a lot of the stimulus that's been paid out to people, which ultimately can result in additional government support being needed at some time because it's not staying in our economy and helping who it needs to help. So spending at this time, what's happening, or what the economist found was happening, was that people were spending a lot on consumer goods, lots of different things, clothing, and much of it was actually exports. So the money that was, like I said, the money that was being used to stimulate the economy and end up in people's hands, a lot of that is starting to essentially leak out when we purchase these exports. And at this time, we're in a very challenging period. Central bankers don't have much more ammo left as it relates to monetary policy. Rates are already at all-time lows. So the burden then falls on fiscal policy makers like the government, who have been providing stimulus at this time. But this leakage is something that is definitely a concern for economies. One of the examples that they used is they looked at retail spending and pitted it against the services. In this case, in the study, what they did is they looked at essentially clothing versus food and beverage services. The reason they chose those two, the data is much more readily available. And what's happening? So with the retail, retail is vital, but the question is how vital at creating jobs, and it does provide consumers with goods, and Canadians have rewarded these firms, especially through the e-commerce space. However, in the services side, we're seeing sales down on the food and beverage services down nearly 60%. It was down 20% in the summer. This was when we had good weather and patios were going, and people were a lot less worried about COVID. So then they looked at this information that we've been seeing in people buying these consumer goods, and what they found was that for almost every dollar that's being spent, about 60% of that is actually leaving the country. So
that's an unbelievable number, isn't it? Like, for every dollar, and especially when you think about like the CERB payments and things like that, if people are buying like clothes, for every dollar, 60 cents of that is leaving towards the U.S. basically. I think it was the U.S. you mentioned, right?
Yeah.
It was going to the U.S. and only 40 cents staying at home. Unbelievable number.
And you look at actually the jobs that these two, so they looked at them, and clothing in particular, 230,000 retail jobs is what the clothing industry supports. And when we added another 50, or the economists added another 50,000 for the manufacturing and wholesale jobs that are out there. And when we looked at that, for every $1 million of sales that the clothing industry does, it provides about 8 jobs to Canadians here at home. Whereas if we looked at the food services, it provided double, so 16 jobs for every $1 million of sales. And I believe we actually have a chart here that we can pull up to show these numbers here. When we look at the food services there, the food services, this was again, these numbers are without adding in the farming, the agriculture, and the food manufacturing. So with the retail and clothing spend, we were adding back those wholesale and manufacturing jobs. However, with the on the flip side, on the food services there, we weren't adding any additional jobs, and it's still double. So the difference, when this data came out, what the economist mentioned was that often when you see that disparity between those two, 16 jobs being provided versus 8, a lot of times that has to do with productivity, meaning that this food services jobs are just less productive, and that's why you need more people. But on the second chart that we have, this difference is actually not due to productivity. And when we look at that, the GDP that's created in the food services versus food services and beverages versus clothing and retail, we're seeing more GDP being produced by those foods and services. So in this case, it is not due to necessarily a productivity discrepancy here, and like we've mentioned, it's as a result of us spending on goods that are being created elsewhere and importing them, buying them off of Amazon, going online. You pose the question, what can Canadians do about this? Well, we got to figure out ways that we can keep this money in our own economy.
Isn't that the question right now, right? I mean, that's the thing. I mean, especially with the lockdowns on right now, I'm generally a big proponent of competition, and I think that Canadian companies need to compete with the global companies, and but with the lockdowns on, it's there's been an unfair advantage created for multinationals. We've seen that here in Winnipeg. I think there was a new announcement today that I think should level the playing field a little bit, but in any case, there's been that discrepancy and an uneven playing field. And
Absolutely.
I think when you look at just basic stats on small business in Canada and North America, right across the board, but in Canada in particular, small business, depending on the metric you use, makes up 40 to 60% of our economy. And I would guess, I don't have these stats in front of me, but I would guess that if you're buying from small local businesses, more of those dollars are staying closer to home than they are leaving. But that would be my guess on that.
The report suggested, and I mean, I agree with it, lowering the virus count and making people feel comfortable going out to spend, because this is the services sector. These are businesses that essentially you're coming in contact with people. So until we start seeing virus counts coming down and people feeling more comfortable going out and about, rapid testing might obviously help that, and being able to test more people and test more effectively is definitely a start. But without those virus counts coming down and the ability to test, it's going to be challenging to have people feel comfortable getting out and spending. Some other suggestions from the report was cutting sales tax on services, hoping to induce some spending there. So governments obviously lose a little bit of revenue up front when they're reducing taxes on those service-oriented businesses, but they may be better off in the long term by doing this to stimulate that part of the economy and get that going again. So some potential there. Obviously, here in Manitoba at this time, not on the table, just given our numbers and given what we've had to do to hopefully reduce those numbers. You're not able to go you're not able to go to a salon or go to a lot of these service-oriented businesses at this time. In Europe, they had, we saw this summer, but they had an interesting program, and it was the UK's Eat Out to Help Out, where essentially the government was subsidizing a lot of the dining out. It was on certain days and up to a certain threshold, but essentially the government was going to step forward and pay for those meals so that people were going to the restaurants and going and spending there and keeping a lot of those servers. And again, we looked at both the GDP and the jobs that are created by those industries, and getting people spending in those places could dramatically help the situation here in our local economy at home.
Yeah, no doubt. I mean, I think at the end of the day, we need to do what we can to support individually. I love these programs. I recently saw a pledge program here in Winnipeg around making sure that we're ordering in from or ordering out from various restaurants locally. And if you pledge to do that once a week, you get entered for a gift card. I think that was Economic Development Winnipeg put that one out.
Yeah.
So I love those programs. I do have concerns over the small businesses in this country. I think there's a recent study said, anywhere from 160,000 to 225,000 small businesses are currently at high risk in the country, which it seems like a huge amount of businesses, and it is. But that's really the backbone of our economy, and so I think that we need to do what we can. I think the government needs to continue to do what they can, but as individuals and consumers, we got to continue to do what we can. Spend your money. Normally I'm a bit of I don't know if I'd call myself a globalist, but I am definitely up for competition, and I believe in it. But right now it's I think we got to do our part and go above and beyond to support as much as we can these small businesses.
Absolutely. And just to add on to that, like you said, the small businesses are a huge part of our economy. The service-oriented small businesses are also extremely large portion of those small businesses. So hopefully we get to a point where the testing is there, potential vaccine, and we can get get people out and about and helping these business owners. But in the meantime, we got to find ways, as you mentioned, that we can support these businesses, because if we're going to come out of this difficult time and economic period of economic stress, the more that we can keep those businesses at least alive during the meantime, the better we will be set up to come out of this. So
that kind of dovetails into this idea of
does.
the K-shaped recovery.
I laugh because for those viewing, there's been a lot of talk about K-shapes and K-shaped recoveries. I know Grant's had a little bit of a mental challenge understanding how the K works, so we can.
It's not really a K. That's why it's a sideways V.
Well, just hold on. We'll get to. There's going to be another chart coming up here. We'll get to it. We'll show you the K. But first, what is a K-shaped recovery, and ultimately why does it matter? I took this. It's a new definition actually, and this comes from Investopedia. This definition has kind of come into play since the pandemic. A K-shaped recovery, this is verbatim from Investopedia, a K-shaped recovery occurs when, following a recession, different parts of the economy recover at different rates, times, or magnitudes. This is in contrast to an even, uniform recovery across sectors, industries, and groups of people. Granted, it's called a K. If you look at the different paths and parts of the economy, in this case, we're focusing on things like wealth and wealth inequality and the different types of businesses that have benefited from the pandemic and those that have been hurt. And if you see it, and we have our third chart here, if you see it, there's a split across the one splitting upwards and one splitting downwards. So if we're looking at the K-shaped chart, you can see some of the businesses that have benefited in the e-commerce space, telecommunications, and then obviously on the downside, entertainment, hospitality, services, they haven't fared so well. But it depends on, what your experience depends on which part of the K you are. So it's an interesting, if you're in the top portion of that K, you're in industries and businesses that have fared much better, have been able to operate and work from home. Often these jobs are with the jobs where you're able to work from home are jobs that are essentially higher paid jobs. So things like bankers, real estate agents, telecommunications, all these things. These are industries that have recovered faster and typically pay more. So they're on the upswing. On the bottom side of that K, we have the leisure, the hospitality, the services. And since March, only a half of these jobs have actually come back, with many now in question, even now, given the recent shutdowns that we're seeing here and across the board. In America, 1 out of every 9 people are working in these jobs with those low wages, and a lot of them are out of work. We saw jobless rate tick upwards for the first time in some time. In Canada, likely the data is very similar. The other thing with this K-shaped recovery is some of the groups of people who, prior to the pandemic, have been experiencing things like wealth inequality and due to whether it be their race or their gender. So we're seeing in this pandemic here, some of these groups that were already affected, that it's again disproportionately affecting them. So think of all the women in the workplace that have maybe had to, even though they were able to get back to work, had kids at home, and so they couldn't necessarily get back to work. So we're some inequality in who it's affecting there as well.
Yeah, it's funny because we were talking about this, and I think our industry's famous for coming up with letters to describe like recoveries. Like, there's V's, there's L's, there's hockey sticks, and now there's K's. And I think that Investopedia definition was written in probably August of 2020.
Yeah,
because it's the latest and greatest in terms of describing the shape of a recovery. But I mean, there's no doubt that there is that gap that's building. The sideways V, K, whatever you want to call it. I would argue that probably in most recoveries that is the case to some degree, but we are definitely seeing it this time around.
Yeah.
I mean, that chart you just had up there just showed, like, even travel companies. I mean, obviously they are nowhere near where they were back in January and February of 2020. And so yeah, whereas you could look at banking or technology or whatever, and that's like way ahead of where we were. So yeah, there's no doubt, there's definitely that differential there. And the question I think becomes is how quickly do those other businesses catch up? Dovetails back to what we're talking about with the vaccine as well. Is that the catalyst for the K to realign with itself on the other side of it, and then we'll have an O.
Yeah, yeah. More letters. We have a fourth chart here, which again, it kind of plays into, you know, K-shaped recovery and why does it matter. And the fourth chart here that we're looking at is essentially it's from the Census Bureau of Household Pulse survey, but it was published out there by Bloomberg is how I came across it, and it looks at covering the basics. And what it says is 32.7% of individuals. This is American data, but earning $25,000 USD or less are finding it extremely difficult to meet their household expenses. In Canada here, while high wage earners have recovered all their work hours by the summer, workers for those making less than $20 an hour is still 20% below what it was pre-pandemic here. So again, you're seeing that disproportionately affect people in different jobs, and unfortunately, it's hurting some of the people when it comes to income levels that are on that lower band. Those who are likely already stretched in the first place, meeting bills on the normal day-to-day, potentially living paycheck to paycheck. We need those people. They are consumers. They are who are buying products. There's a lot of people fall into this camp. So when you get these numbers of how many people are actually struggling, it makes you think and wonder of how soon are we truly going to be on the other side of this economically, at least. There's another chart I wanted to put up here. It's our fifth chart, and it looks at again just talking about. So it's job cuts, and two of the lowest paid industries are seeing the biggest losses of jobs through this pandemic. So you'll see there leisure and hospitality, 49.3% during the pandemic. Now they're sitting at around 24.5, but with more shutdowns, that could change again. Other services, information, financial services is on the better end. When we're looking at job losses down. Pandemic, it was down 3.2%, and now it's back up to being, just under, lost 2.2% of the jobs. So again, an inequality on who's lost jobs and who's actually getting back to work, which, it does matter. If things don't get if things don't get better, people in the upper K can start falling down to the bottom K, and some experts believe this would be, again, a lot of women in jobs like schooling and daycare, if those had to get shut down because numbers did continue to spread. I know from a lot of the reading that I've been doing, one of the big concerns out there for economists is people actually leaving the labor market altogether, just fed up with it and just exiting altogether, and what does that do to the economy as a whole?
Yeah, I think that you're absolutely right. The wealth gap is widening, and that's concerning. That creates a lot of problems, and especially in a country that, again, based on consumerism and spending consumer dollars. One of the concerns you probably have is the wealthy are getting wealthier, but it doesn't mean they're necessarily spending more money too. And then what ends up happening is the money gets just basically saved into coffers, and it loses its velocity. Whereas people that spend money, that really keeps the economy going and keeps the velocity of the money going, and that's what moves things along. So you could argue that the wealthy, the people that are just banking the cash, that's the worst thing that can happen when in these types of situations. And you need the money to move so it can flow to other people so that they can go on living.
Yeah. We need the consumer essentially for the entire economy.
Yeah.
Wanted to talk a little bit about real estate. With the whole work from home trend, I know we've kind of been on an office rotation here at Endeavour. Some days in, some days out. We were even shut down at one point where everyone was working from home. just even being downtown, you're seeing a lot of office space that is not being used. So it begs the question with real estate: has the pandemic changed the game?
Yeah. So I'm going to say this with a caveat because I think it's too early to say, and I think that I do think that trends are changing, and I think people are realizing that there's advantages to work from home, and there's certainly a cost advantage when it comes to companies leasing spaces. But I think it's too early to tell. Everybody's famous for saying it's like this time it's different. This has changed everything, and then what we see is companies get fat again in a few years, and they start spending money and so on and so forth. So I do believe it has changed. Time will obviously tell. But this isn't just about office space, though. I mean, there's huge trends that are changing, I think, right through the real estate.
Well, I was going to say it really, the question is almost too general, because it really does depend on what you mean by real estate. Are we talking about office? Are we talking about retail, industrial, housing? Each of these is very different in what they essentially provide.
Yeah, absolutely. Well, I think if the pandemic is famous for anything, it's about pointing out the cracks in our systems, and there's definitely been a crack that's been found in supply chains, and there's been a crack found in manufacturing, and so if you look at that, I mean, what was the biggest concern like earlier on, and probably still, is that we couldn't manufacture like things like PPE fast enough because we've moved a lot of our manufacturing.
What about our toilet paper? I was so concerned every week about toilet paper. Like, what's going on? Like,
yeah,
you're going back to Safeway, it's still gone. You go to Sobeys, nothing there.
How about that though? Stockpiling, inventory. Like, I mean, you're talking about your personal toilet paper inventory, but I mean more for like supply chains. Retail business that was not able to get the inventory they needed in a timely manner. So you saw shutdowns of it. Or you saw slower sales, which is ultimately a problem for retailers, right? So are we about to see a boom in warehouse space because companies need to hold bigger inventories that they never thought they had to? I mean, it was all about like shipping all of that out. It costs money to keep it here and all that stuff, but yeah, that's all good until there's a pandemic and you can't get your goods over from China or wherever that you're manufacturing them. And likewise, you look at Apple or any of the big companies that are manufacturing and have a lot of their parts being developed or manufactured in China, and does that create problems and expenses and so on? So, I mean, if there's one thing Apple hates, it's disruption to their supply chain because that costs them a lot of money. So I think that there is huge opportunity potentially in warehouse space, in manufacturing space. How far that goes, I don't know, but I think that there's an opportunity there that wasn't there, 10, 11, 12 months ago. But likewise, on the other side of it, office space. Yeah, I think companies are realizing that maybe we could deal with having 50% or maybe 2/3 of our existing office footprint and cut our costs down because our staff was as productive at home.
Yeah, I'm not of the camp that office space is going away, and I hope there's not too many people that are in that camp, because I think that to me sounds ridiculous. I think there's a lot of people who love coming into the office, and there is more from a collaboration perspective. I always find being in the office and being able to work in a team, having access to that team and being right there with them provides me something that doing the video calls just doesn't. But at the same time, there were points where things about working from home and the ability to work from home that I really enjoyed, and I think I know a lot of other people out there who would say the same. So I'm of the mindset that we're going to see a lot more of this hybrid model, the ability to work from home a couple days, come into the office. I'm not a fan of this like job rotation or office rotation where it's like scheduled per se. Though I guess if you have a large office, that may be what's required in order to make sure that there's a place for everyone if you have a large number of people, but you've reduced your office footprint. So I don't know if we can say for certain which way it's going to go, but definitely things are changing as it relates to office. I had some interesting information that I pulled up from the real estate company JLL, which looked at commercial real estate being down 29% globally in the first 6 months of the pandemic. REITs were also suffered the first part of the year with total returns across the 8 major global REIT indices hitting their lowest point in March. JLL talked about some defensive sectors, which you kind of touched upon here, Grant, but defensive strategies during the ongoing uncertainty that benefited essentially from it were a lot of the industrial businesses. You talk about the ability to produce products and house these products. Industrial seemed to be a defensive play. Multifamily and then a select number of like alternative sectors, things like data centers. I know we're big believers in the future of cloud and what that's going to mean. So even places like that actually fared quite well during the pandemic. The supply chains and the e-commerce, as you mentioned. So there's definitely some interest there from a logistics sector globally. And from JLL's standpoint, this has been reflected in the recent investment activity with the sector's investment volumes only really dropping 13% in the first half of the year. So it's a lot smaller number than the 29% globally. So a lot of the things that we need during a time like this where we are moving towards digital solutions and ordering online, obviously propped up that part of the sector. And the other thing JLL pointed out was housing is still needed. So multifamily sector has been another beneficiary with some enduring issues around housing supply and affordability in a lot of the major global markets. In Canada here, we can look to Vancouver, places like Toronto. There's a lot of people that are still priced out of buying a home, and so they're needing to go to places where they can essentially rent a place to be a home. And this sector has been a beneficiary of this COVID time as well.
Yeah, I think it's more of a rotation again, out of maybe what you thought was be. I mean, if you were invested in office space in downtown large cities, maybe that's gonna change for you, and maybe you should take a look at that, because I can tell you a lot of companies that we talk to are evaluating that real estate position right now. But that could find a home somewhere else in other forms of real. I think real estate in general is not going anywhere. I think like real estate can still be a great investment. It just depends on what type of real estate. And there's lots of different types, as you pointed out from that report with JLL. So, but actually, like I said, I think it creates opportunities in other places, like the pandemic, and any situation that we see where there's an economic downturn. There are opportunities in it. It's just about who's able to take advantage of them, and what does that look like. And like I said, I think there's definitely opportunities there.
Absolutely, which brings us. We're talking about changing and the pandemic changing the real estate environment here. We know firsthand, just being in the financial planning and investment space, that the pandemic has changed a lot there. And so wanted to kind of talk a little bit about financial planning mid-pandemic and what can households do. And where I wanted to start, Grant, because I believe that this pandemic has taught us more than anything else that the unexpected, it can happen. There's always something that can happen. It's unexpected for a reason. We don't expect it. I mean, there's a lot of smart people that were warning of this pandemic, but at large, most people, this was not a thought in our mind. So with that, I wanted to talk about first, get your thoughts on emergency savings and what essentially the pandemic has taught us, and what people should be doing in the emergency savings part of their financial planning process.
Yeah, so like this is it's so funny, because it's like we see the situation over and over again. I saw it in the financial crisis, like, and again, you look back and you're like, oh well, people should have seen that coming. Yeah, but again, who did? I mean, you got the big short people that saw it, and then there was everybody else, so you got like 5 people that saw it. The pandemic, yeah, Bill Gates warned us about the pandemic 5 years ago. But who was paying attention, right? And why was it this year? And nobody knew any of that stuff, right? So it points out the need to always be planning for these things, because you just never know when the next pandemic, financial crisis, long-term capital management, any of those situations is going to come up that's going to cause a market crash, right? So why do people waste so much time trying to predict these things? Anyway, it's a futile exercise to me. What is a worthwhile exercise is planning the fact that there will be another market downturn. There is always another market downturn coming. And the question is when, and you have no idea. So what do you do to plan for that? And it's funny, I was just chatting with a client today on this, because, he, and for good reasons, concerns about the future, concerns about what happens. Like, there's a lot of bad news on the news networks right now.
Yeah.
And so what maybe 2021 is not as rosy as I might think it is. Maybe these vaccines don't work out. There's a whole lot of reasons why things
Yeah.
could still be bad next year, right? Like I said earlier, we're one bad news story away from a 20% market drop. So what do you do? And I think it's a case like it depends on your situation. Like if you're retired, I'm a big fan of having plans in place like a cash wedge strategy, which basically segregates out 2, 3, 5 years of your income into ultra safe, ultra low volatility investments, so that no matter what the stock market does, your income for the next 3 to 5 years is taken care of. You don't have to worry about it. And by the time you actually need that stock market money or more volatile money, it's had a chance to recover in that period of time. At the same time, you don't have to be retired to have a good emergency plan in place.
Mm-hmm.
Like I think that it's worthwhile for most, if not all, people to have an emergency fund set aside, whether that's cash. Some people like to use credit, like lines of credit for it. I'm a big fan with clients of using just a little bit of cash and set that aside, and whether that's
So
3 to 6.
yeah, I was going to say
3 to
how
6
much, Grant?
months.
Yeah, how much? 3 to 6 months is what you would suggest?
Yeah, I think so. For more conservative people, I like 6 months. I have 6 months of your expenses set aside. So expenses doesn't mean necessarily like what you spend on a single month. If you think about what you could cut down to, have 6 months of that set aside. I wouldn't have any more than that in most cases because, frankly, it's dead money. It doesn't earn a lot right now, especially when interest rates are next to zero. You're earning very little. You're earning less than inflation in most cases. And so you got to be really careful not to have more than that. But it does give you that opportunity to weather any storms, or at least most storms that you might see. If you lose a job, if you have a disability, you can't go to work. We saw people shut down businesses this year that you never would have guessed would get shut down. Dental offices.
Mm-hmm.
We work with a lot of dentists, and we never expected that dental offices would ever be shut down. But thankfully, we planned and had emergency funds set aside, and not just like personally, but in businesses, where they're able to weather that storm, because insurance wasn't there to save you in those cases. There was a lot of insurance companies that weren't paying out. There was no insurance for the pandemic, and a dental office shutting down. So in any case, the point is, that's how you plan. I don't think this is pandemic planning. I think this is planning in general, and that's what you should be doing all the time, because whether it's a pandemic in 2 years we're dealing with, or a financial crisis in 5 years again, whatever it's going to be, there's another one coming.
It's often too late. With the pandemic or 2008, once you're in it, that's not the time to be doing the planning.
It's too late.
It's nearly impossible at that point if you haven't done it. So this is why if you're hearing this today and you are in a good spot, maybe time to start thinking about some of that planning. I wanted to move on to investing. Sorry?
Well, I was just going to say, here's the flip side of that. Here's the advantage of that.
Yeah.
Come March, when you had 3 weeks to invest in really cheap assets, guess what? You had an emergency fund that maybe you didn't need as much of, and maybe you had other assets you could rotate into, but there was your dry powder, and you were able to go buy, like, I don't know, Microsoft, that's up like 30% from the bottom or something like that. And you got to buy some fantastic businesses and gained 30% over the next 9 months because you had that cash set aside. So it's, part of it's safety, obviously, but the other side of it is, having that dry powder available to you for opportunities.
Yeah,
that's worth so much.
Which brings us to the investing portion of financial planning mid-pandemic. Maybe you could share a little bit about some of our philosophy around asset allocation. I think this downturn has taught a lot of people that they maybe didn't have the proper asset allocation, and so if you could touch a little bit there on some of the things that can be done mid. We're saying pandemic, but mid kind of market crisis, market crash.
Yeah, well, undoubtedly, like this happens all the time, is people get greedy. So you see the longest run up in history. This is leading into the crisis, the longest run up in history that we saw leading up to the pandemic. And I'm sure, we were pretty consistent and disciplined about rebalancing clients. So I don't think this wasn't our problem, but there was a lot of people obviously that got over ahead of themselves in terms of volatility leading into it. And that happens all the time. So I think, investors need to be really careful about that. But, based on where we are today, again, we don't have that crystal ball. I don't know what 2021 looks like. I think it's looking better than 2020. But in saying that,
let's
hope.
Have
been pretty good this year. So, or certain parts of the markets anyway have been pretty good. So I think that the biggest key is you got to stick to your discipline. I mean, we're big believers in our strategy, which I'll just summarize in a couple key lines, which is we buy what I feel are ultra quality or ultra high quality assets, whether that's businesses, real estate, bonds, whatever it happens to be, ultra high quality, and we really make sure that we don't overpay for it, because I think that's the biggest culprit that gets people. You know, you can buy a great business, you can buy an Amazon, and if you overpay for Amazon, it can be a bad investment really fast on you. You know, I would say that's what you need to stay disciplined to. In our cases, we need to just stay disciplined and not chase returns, not start chasing stories that are going on out there. Stick to our process. For other investors that aren't necessarily working with us, that are watching this, having a disciplined process in place is the ultimate key. If you do not have a process, or your advisor doesn't have a process in place, then it becomes very wishy-washy, and I would question what the direction you're ultimately heading down, and it creates that much more uncertainty around what the future holds. But at the very least, with a disciplined process in place, you can stick to it, and eventually it should work out as long as you stick to it.
Absolutely. Wanted to talk about interest rates. We have interest rates at all-time lows. So obviously, if you're investing in bonds and fixed income, not the best rates there that you'd be earning. But there's the flip side of when you're borrowing money, whether it be for mortgages, businesses, things like that. So if you could maybe talk about some of the planning aspects that come into play when we are seeing interest rates that are significantly lower than maybe the interest rates you have today.
Yeah. So almost no incentive to pay off debts right now, right? Like, I mean, you basically have free money. I was looking at a mortgage yesterday with a client, and their mortgage is at, I think, 1.8% is what they told me. 1.8% per year, just basically free money out of a bank right now. But that's not to say you don't continue to pay down debt. I mean, it ultimately comes down to this: like, interest rates are all-time lows. It's pretty easy for an investment to outperform interest rates on most kinds of debt out there. So the financial answer, the math answer, is to say invest versus paying down debt. But we know that there's a human factor to all of this stuff, and I think that's something that I pride our group on at Endeavour here on understanding better, is that there's people behind these investments, there's people behind this debt, and so what's ultimately important is, can you sleep at night? And if this debt really bothers you, if you lose sleep at night, it's just, you got to get rid of it, or at least have a plan to get rid of it, then that's one of the most important things you can do. So I think that where interest rates are today is, it's certainly advantageous for borrowers. It's a good time to be a borrower, bad time to be a lender. And so that also creates opportunities, but it's also, you have to be mindful of your own personal situation and have a plan, because 5 years from now, the situation could be different.
Yeah.
2 years ago, we had interest rates 2% higher than where we are today. That creates other challenges too. I mean, we've looked at the bond situation, and in any case, the point being is that, interest rates can change, and they can change quickly. I mean, if inflation ever really came in a meaningful way, the Bank of Canada will look at interest rates really fast. And I'm not suggesting that's going to happen in next year. I don't know. I think the Bank of Canada set guidelines for 2 years from now is when they see their first increase, but things change, and I think that. I think that it's something to be mindful of in your portfolios right now, that, if inflation starts kicking in with all this money that's been printed, interest rates can go in the wrong direction for you in a quick way, and you want to be adaptable to that very quickly.
I know I've seen a lot of activity as well on both the debt consolidation side of things. So if there's high interest debts out there that you're paying, and being able to potentially, if you have equity built up in your home, refinance and consolidate some of that debt into lower interest rate debt, and so I've seen a fair bit of that, and then as well just accessing equity. I'm not saying that would be the right thing for every client, but I do know we have clients out there who are fairly comfortable using money and leveraging that to be able to take advantage of other opportunities that are out there. So seen some activity on the refinancing side because those mortgage rates are so cheap. So it can make sense in certain situations for sure.
No doubt. I mean, if you're paying high interest rate debt right now, it's definitely an opportunity to be looking at refinancing that, saving yourself some money. We've done that. We've saved clients thousands, maybe tens of thousands of dollars in refinances over the last year, just by looking at like their mortgages or whatever it happens, other debts, lines of credit that we consolidated, things like that. And so if you're paying higher interest rate debt, it's definitely worthwhile looking at right now.
Perfect. Well, really, Grant, that brings us to the end of the topics we wanted to cover today on our first Endeavour Exchange. So we hope that those who tuned in enjoyed the topics we discussed and learned something from them as well. We encourage you to check us out on YouTube, check out our website, www.endeavourwealth.ca. We have lots of great content on there. And then, as always, if there's any questions about your own situation or your own investments, the financial plans you have in place, our team is always, Grant and I are always ready and willing to lend our opinion and provide a second opinion on some of the things that you're doing. So I don't know if you want to add anything there, Grant.
No, I think you finished things off nicely.
Perfect. Well, with that, we'll close it out.
Thanks very much.